Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 7 years and running, the team from GulfCoast Financial Services. Founder and CEO John Kuykendall here with us, as always, providing the guidance and perspective on the financial and economic world so that we can make better, more informed decisions with our money, make sure that each and every dollar is working its hardest to help us achieve our important financial goals. John, in this economy, with this market environment, that is no easy task. So we certainly appreciate your perspective and guidance with the years of experience that you've had in financial services, giving us that insight that we really need in order to navigate these troubling times.
Well, thank you, Peter. This marks 50 years that I've been in the financial industry, 20 years in banking and 30 years as a financial advisor. And I got to tell you, this is kind of reminiscent of the 80s when we had the 20% prime, but also this is a lot different. Things are a lot different. The economy's tighter, employment's tighter. Things are different than when we were back in the 80s, and everything cost more. I mean, everything is rising. And one thing I wanted to talk about, Peter, before we got started was people, we have all this talk about interest rates and the Fed raising rates on the Fed funds and the money. And people say, well, why does that matter? It really shouldn't make a difference. Well, as you know, home loan interest rates have gone up. I heard this morning that they're actually in the sixes. And if we get the Fed increase today, they're going to be close to 7%. And I wanted to take time to just show our listeners that, a $430,000 30-year mortgage at 2.5%, the total interest over that 30 years is only $163,000. Now, and your mortgage payment's $1,812. But if I make that same loan at 5%, the total interest is $361,000. It's 121% increase by going up 2.5%. So, interest rates make a difference. And as we get into this environment where we have rising interest, we've been blessed with lower interest for 20 years now. And as we get into this higher interest rate economy, things are going to be a lot different. And people need to make some really intelligent decisions about what they're going to pay for their home loan, whether they can afford to sell and buy again. I hear that all the time. I'm going to sell mine and take the money out of mine and buy one and refinance it. It makes a big difference. And so I want all of our people out there to understand the importance of having that income plan. And if you make changes to it, or if you're thinking of making changes to it, take it to your financial advisor and let them look at it and show you what the cost is going to be.
Well, I think what most Americans probably focus on is that bottom line payment, that $1,800 a month mortgage payment. And, 30 years ago, when interest rates were reminiscent of where they are now in the double digits, $1,800 a month payment could only buy maybe a $200,000 home. And then as interest rates fell and fell and fell over the course of the next 3 decades, it could buy a $300,000, $400,000, $500,000, $600,000 home. And that's why there has been so much activity in the refinancing, in the moving, in the real estate market, people moving up in larger and larger sizes of home because they could afford that payment. The payment is the same. And now somebody who may have been shopping for a $400,000 or $500,000 home at the end of 2021 to stay within the same payment, John, really is now looking at more like a $300,000 to $400,000 home. And that's probably going to slow down activity, and all of those gains in the price of our home that we were all so euphoric over at the end of 2021, there's probably going to be some pressure in the opposite direction as a result.
Well, that's right, Peter. That's what happens. I mean, it's just the real estate market's kind of like the stock market. We have good days and we have bad days. And so what's going to happen is that we're not going to have the value that we thought we had built up in our homes, because as they're not, the prices are going to come back down. Refinances are already off. Everybody that I've talked to has said that the refinance market is dried up.
Yep.
Because, I'm in a 6, I'm paying less than 6. Why refinance, right? Unless I've got a real credit problem, and then I'm not going to be able to refinance. But the fact that this a supposed appreciation in our homes is because of the fact that the interest rates have kept prices low, and as you said, we can buy more homes. Homes were never meant to be an investment vehicle. They were meant to be a place to put, your head
Your
down
family.
at night.
Yeah.
Your family, your roof was dry. You could get out of the rain. It wasn't meant to be an investment. And the same thing goes for all these people that have bought extra real estate and bought extra, bought these investment properties. They're not going to be as sellable in the future. So hopefully you've been diversified and you had a plan. You understand what you're doing. But like I said, a house is not an investment. It's a place to put your family and live.
Well, may or may not be directly connected, John, but it's still, it was a little scary when I heard it, that there is a large secondary market for the mortgage-backed securities. And I'm sure we all remember that terminology, that phrase from 2007, 2008. Well, recently, that secondary market had a large sale for mortgage-backed securities. And for the first time since 2008, nobody was out there purchasing on that secondary market. So it just seems reminiscent. And I forget if it was Bill Gross or Robert Schiller, but one of them is famously quoted as saying, "History does not repeat, but it often rhymes." And you mentioned, the interest rate and the inflation environment in the 70s and 80s, and then the mortgage scenario of 2007, 2008 with the mortgage-backed securities. It's just, we are facing some interesting economic times, but it's not without precedent either, except for the fact that we are now additionally $30 trillion in debt as a country.
Well, that's right. The Fed issued so much money in 2020 that now we're paying for it with higher inflation, higher interest rates, because we have to raise interest rates in order to get the inflation down. And so in order to get the inflation down, it's going to impact a lot of different places in our society, places that we really don't think about. And so I just thought it was interesting that interest rates are rising. People don't really understand, I don't think, totally what it means, but it's going to impact everyone eventually. And so you need to be ready. And hopefully you've talked to your financial advisor and gotten some good advice on that.
Well, if you feel like maybe you need some good advice or need to speak with an advisor, pick up the phone and give a call to the team from GulfCoast Financial Services, 386-755-9018. That is 386-755-9018, 386-755-9018. They do offer the opportunity for a complimentary review, evaluation, and strategy planning session. If you would like to take a look at the risks that you're taking, the fees that you're paying, the investment allocation that you have, how to tap into various accounts to create income, what is the most optimal way to do so, pick up the phone and give them a call, 386-755-9018, 386-755-9018. You can also visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, you've brought along a list, a resource, as you often do here. This is something that savers and investors can call and request, or click the link within the description of the video, something they can download, go over on their own time, or when they come in, you can help review these critical mistakes to avoid. The report is titled 5 Planning Mistakes to Avoid for Financial Security Throughout Retirement. Number 1 on the list, John, not having a grip on your retirement. What is the grip?
Well, that's what we're talking about with guaranteed income, retirement income plan. So we need to have an income plan that is guaranteed. And what we're looking at there is Social Security. Well, everybody should be eligible for Social Security. We want to make sure that we maximize it and understand how we're taking our money. Our pensions, our pensions that we have from our companies, if you're still lucky enough to have one, and then our savings. And so what we want to do is make sure that we cover that income gap with what we call guaranteed replacement income plan. So we want to make sure that we've got our income plan covered by that GRIP. A lot of people don't do that. They have Social Security and then they have their growth bucket and they're trying to live out of their growth bucket. And Peter, as you know, right now is not a great time to be taking money out of my growth bucket.
Right. Yep.
I mean, if my bucket's down 30%, and I talked to some people last night at our car show, we had our antique car show, they, their advisor has kept them in the market and they are down 25, 30%. If they're taking money out, we're subject to that. As you know, we're subject to our money running out a lot quicker than we thought, and therefore the income plan won't work.
Taking out a much higher percentage with each withdrawal, locking in those losses and removing those dollars' ability to participate in any recovery when that eventually does happen. And that is something, John, that a lot of people may not understand if they have not been in that situation, but those that have been through it in the dot-com bubble in the 2007, 2008, they understand how much that can impact the trajectory. Removing dollars when the market is down is not something that is beneficial for your long-term financial forecast. And that's why having that grip on your retirement, the guaranteed retirement income plan, John, is so important for our financial security.
Well, that's right, Peter. I mean, I don't think it's been 14 years since we had 08, and a lot of people have gotten complacent and they like that growth and they like that, those returns. But those returns aren't going to happen every year. We know the stock market doesn't always go up. And so if I've lost 20% and I've taken out 8%, I'm down 28% and I've got to make that up before I gain any. And so it just puts that much more pressure on your plan long term. We like to get a grip on it. We want to make sure that we got the grip covered.
Number 2 on the 5 planning mistakes to avoid, taking inappropriate risk. Now, John, we know, we understand, we've been taught that some risk is appropriate and in some cases necessary in order to make the growth above the rate of inflation on our dollars. But there's also inappropriate risks, and walking that line, understanding where we are and where our investment portfolio falls, making sure things are in alignment is vitally important.
Well, that's right. And we've talked about that on this show many times. I mean, an old mentor of mine at the bank told me you can't have reward without risk. And so what the question is how much risk am I willing to take for how much reward? Right now, a lot of people are wishing they had taken less risk because when the market turned down, and they didn't make some changes to their portfolio, the portfolio has a lot more risk in it than they wanted. And we're seeing that every day as we do these consultations with people.
However, John, I think the American investors by and large have been trained to focus on the reward side of that first and foremost. And if it always worked out that way, we would all be aggressive investors. If taking risk always was associated with making higher returns, we would all be aggressive. But that is simply not the case because risk is risk. And we really need to focus first and foremost on the downside potential because that is the part that is going to truly gauge our risk tolerance.
That's right, Peter. But Americans aren't like that. Americans, we make what is the average investor makes 3%, the market makes 9 something.
Mm-hmm. Yeah.
I mean, what happens is we get into this thing where we're out of the market, and then the market starts going. So then we get into the market, but we're getting in not at the bottom, we're getting in near the top, and then the market starts to drop like it's doing now, and then we want out. And so what's happened is your risk never was aligned with your investment philosophy. it was aligned with what your neighbor and what the talk was on the street and everything else. You didn't get aligned. If you have the right alignment, you're going to stay in the market. We can't afford not to take some risk, because if we put our money under the blanket, we'll never make any money, and we're going to run out because we need more money. Inflation averages 3.8% up through last year for the last 20 something years. So we have to make at least 3.8 to keep up with our bargaining, with our buying power. So we need to make something, but we don't need to be so risky trying to get in that aggressive growth fund. I always talk about the guy who wanted to buy the Jacobs Internet Fund because it was doing 100%. He just loved it. And then one day I called him and I said, okay, that $10,000 we put in the Jacob Internet Fund because you had to have it is now worth $200. Do you want it? Because what goes up fast was going to come down fast in a down market. So that was too much risk. So you need to be apportionate. Your risk needs to be appropriate with whatever your investment philosophy is.
Yeah, you mentioned alignment, and I've been driving my wife's car, and I noticed that as I take my hands off the wheel, if I sort of just let it go, we're drifting to the right and drifting to the right, and I'll get it back going straight and take my hands off, and it's drifting to the right because something is out of alignment. I need to take it into the shop for her. But as you mentioned that is the thought I had, and that's what's going on in a lot of people's portfolios. We are off track and off course. And a lot of the way that Americans invest, John, is with the hands off the wheel. We're not making that readjustment to get back on the right track. And if we are out of alignment, that can veer dangerously off course.
Well, for the past 14 years, we've been growing. The growth portfolio, your growth part of your portfolio has been growing. And if you haven't rebalanced it and readjusted it, you're now out of sync. You've been out of sync. So when the market went down, you're naturally going to go down faster because those growth stocks and those aggressive stocks are going to tank. So what happens is you need to tweak that constantly. That's why we need to review the income plan. We need to go over all of the components of it, including your investments, to make sure that you're aligned. But one thing, Peter, it's like even with a car that drives itself, if I run over enough curbs, it's not going to stay straight. So
and unfortunately, we've heard those stories.
Yes. So I can't just say, okay, I'm going to get in the car and let it drive myself. We have to make adjustments. And that's the same thing with our portfolio. We have to get that front end aligned. We have to get that portfolio aligned with where we are today.
All right. 5 planning mistakes to avoid for financial security throughout retirement. Call and request this list, ladies and gentlemen. Great to go over on your own time. Provide this list to a loved one, a spouse, a family member, friend, neighbor, coworker who may be thinking about retiring. They will appreciate the guidance. And of course, you can always review your plan to make sure that you are not falling for any of these 5 planning mistakes to avoid and jeopardizing your future financial security with John and the team there at GulfCoast Financial Services. Give a call 386-755-9018, 386-755-9018. Next on the list, John, the gross planning mistake, kind of a pun, a play on words here. The gross planning mistake is a lot of people are looking at their tax deferred balance and planning retirement based on gross numbers, not what they actually get to keep.
Yeah, unfortunately, Peter, we're not going to get to keep all that money. So, we were taught for years and years to defer. Well, your taxes will be cheaper in retirement. Taxes aren't going to be cheaper in retirement. I can tell you that. And taxes or income in retirement, they account for a lot of different levels of other things that cost us money, Medicare Part B. So, one of the things we need to do is we've taught to defer. We need to, we now teach, do Roth, do things that don't, life insurance, so that we can build up tax-free income and not have all of that money that we have to take out of our deferred accounts when we really don't want it. Even at 72, you're still active, you're still going, you're still spending. You're going to not want to pay all the extra taxes you're going to have to pay on your money.
Yeah, we've got to figure out what we actually get to keep, and inside those tax deferred balances. There is a debt to the IRS that they are expecting to collect on. They don't forget about those dollars they allowed us to save and invest and grow tax deferred. Deferred being the key word, not tax free, ladies and gentlemen. It just means you still owe that bill later on down the road, but now may be a good time to plan and prepare and execute on strategies that can help make those dollars more efficient and minimize that tax bill. You want specific guidance on that from a financial and a tax standpoint, and that's why there's a benefit there yet again at GulfCoast Financial Services with sister company GulfCoast Tax Advantage. Under one roof, they can help you look at both angles, the financial and investment piece and the tax planning angle. Give them a call. The difference in deferring to the IRS's plan or being proactive here can be substantial over the course of your lifetime and for the life of your IRA account. So don't make that gross planning mistake. Plan proactively. Now is the time to do that. Give them a call, 386-755-9018. Number 4 on the list, John, not caring enough to plan for long-term care. And, you know, I know that there's a play on words here as well. But I don't feel like it's that people don't care. I think that people feel a little helpless about this one. This is like that 800-pound gorilla in the room that we just don't know what to do about.
Well, that's right, Peter. I mean, you know, long-term care insurance, when it first came out, they made a lot of mistakes. And so a lot of them have gone broke. A lot of them have gone into receivership. And very few companies today issue traditional long-term care insurance. And so that's why we have to find these hybrid products, the ones that will help us provide long-term care, but at the same time, give us a lifetime income and give us some protection. I think you're right. I think people don't understand it's available. It's not that it won't cost us that much. It's really not a cost. It's something we can add to the policy. But I think that a lot of people think I'm never going to need it. You know, I'm invincible.
That
as we get
Superman
older,
syndrome.
Yeah, but I'm going to tell you something. As we get older, I'm going to tell you from experience, we don't do things, you know, like we used to do. I used to laugh because people would say, I'm retired, but I don't have any time. And I couldn't figure out what they were doing other than making doctor's appointments. And I realized that what it is, they're still busy. It just takes them twice as long to do everything, you know, because you go out and you mow for 30 minutes instead of an hour, and you come back in and rest for 2 hours and go back out and do the other 30 minutes. So it just takes twice as long. But we need long-term care coverage. I think a married couple, and what the number's like 70 up in the 70% chance that one of them will need long-term care coverage. So why not make it available? Dementia, who knows when dementia, I've met with a person the other day, 63 years old, got dementia, early onset dementia. So we never know when it's going to happen to us. We just need to prepare for it. It's something that we can provide as a hybrid product that will take care of some other needs, but at the same time, add a little extra protection for long-term care.
And this is one of those things that any responsible adult that doesn't want to place burden on their loved ones, on their family members, that does not want to become dependent on their family members or the government to determine their standard of care, needs to take some time to discuss with a planner and advisor and address at their level of comfort. But you can't simply leave this conversation unaddressed and unplanned for and unprotected against, because that cost of care is exorbitant and far more people end up needing it than really realize it. The Department of Health and Human Services, John, you're right, put that number right at 7 in 10 of us, 69.8%. So as close to 70% as you can get, essentially. You need to have a plan that addresses it, ladies and gentlemen. Number 5 on the list, not using Social Security to provide for effective financial security, John, is another planning mistake to avoid. We need to do a better job with Social Security. We know it's there. We know it's a fantastic benefit. Most of us leave money on the table.
Well, that's right, Peter. It's complicated. There are a lot of different ways to file. There's a lot of different ways to get your money. Not as many as there used to be, but there still are options available to us. Social Security Administration is not there to help you tell you when to take your money. That's not their job. They're not going to show you when you're maximum and when you're minimum. A lot of people get scared too that well, Social Security is not going to be there. I'm 62, so I'm going to go ahead and take it, not realizing there's a 27% haircut on day one. Plus, I've also limit my earning power of what I can make until I'm full retirement age. So we need to know the right decisions. We need to run that Social Security maximization. It's the cornerstone of your retirement. It's the check you're going to get every day. Now, one thing we're talking about a lot is that Social Security is going to run out of money to fund 100 cents on the dollar in 2033. That's the new Social Security Administration report, 2033. There's enough money there for almost 80 cents on the dollar. If we don't make any changes to it, you're going to get 80% of what your check is today. Now, if I take a 27% haircut because I drew early at 62 and I lose another 20%, it just doesn't make economic sense to do that to your retirement.
Yeah.
And you need to be aware of these things.
You're talking about 50% less money, half the money that we could have had off of Social Security through poor timing and somewhat mismanagement. But John, I think that they will probably eventually, when the rubber meets the road and we get right down to the last minute, probably try to do something about it. Hey, over the course of the last 14 years, due to the Great Recession and the COVID downturn, they pumped $9 trillion into creation and into the economy. Maybe they do something or make some similar changes that they have before in raising the full retirement age. I expect by the time I get there, maybe it's 68, 69, 70. By the time my son gets there, it's probably 72, because we are living much, much longer lives than we were when Social Security was first incepted.
Well, that's true. I mean, Social Security, what with life expectancy was 62 and the retirement age was 65.
Right.
I mean, you weren't supposed to get it. It wasn't there for you at the government. They did it to make you feel good, but it wasn't meant to be your retirement source. The problem I see is that they may do an index like they did for Medicare Part B. And that is that based upon your income.
Testing a little bit.
Yeah. So if I have a certain amount of income, I may get a certain percentage of my Social Security. And so, all of our clients who are fairly not great off, but have assets, it may be that they end up taking the haircut. So I just want our people to be aware of it. I want to make sure that we try to maximize it the best we can, and that we use that program we've got, which tells us everything we need to know about Social Security, when to file, how to file. And I tell you, Peter, a lot of people are leaving money on the table because, we had an individual not too long ago that we actually were able to get him a spousal on his wife and let his continue to age 70, and he didn't realize he could do it. Mm-hmm. So it was like $600 a month that was left on the table for a couple of years. We could have done it sooner. So
not the job of the folks down at the Social Security Administration office to educate you on that or tell you if it's the best day to show up. Their job's to help you file the paperwork on the day that you do show up. So you've got to seek that information and education. And that's, again, one of the 5 critical planning mistakes to avoid for financial security throughout retirement, and certainly one of the topics that John and the team from GulfCoast Financial Services can help you to address. Pick up the phone, give a call if you'd like to request this list, or if you'd like to go over any of these issues or questions of your own with John and the team. 386-755-9018. That's 386-755-9018. John, as always, thank you for the helpful resource. Thank you for the conversation in informing savers and investors across North Central Florida of these important issues and then being a resource for them to address them.
Thank you, Peter. It's great to be here. You have a good week.
Always a pleasure.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.